Hello everyone, and welcome back to Simply Wall Street's Market Insights. I'm Michael, and this week we're diving into supply chain opportunities in oil and gas. Last time, we explored the evolving outlook for oil and gas in both the short and long term. But this week, we're zooming in on the medium-term outlook, a time frame that's probably the most relevant for investors right now. We'll break down key countries, industry dynamics, and what it all means for companies in the sector. So let's get into it. Now, let's start with the big picture. The International Energy Agency's Oil 2024 report lays out a roadmap for the oil and gas market through 2030. While things can certainly change, this gives us a solid base case for what's ahead. And the headline takeaway? The IEA is forecasting that global demand for oil and gas will soon plateau, while supply is expected to grow significantly. But here's where it gets interesting. Demand isn't uniform across all regions. Different economies are moving at different speeds, and that's shaping the trajectory for oil consumption. And that brings us to one of the biggest dividing lines in the global oil market, the contrast between developed and developing economies. When we compare the outlook for OECD countries, those are developed economies, versus non-OECD countries, or developing economies, the differences are striking. In developed nations, demand for oil has already peaked thanks to more efficient energy use in cars and buildings. The rise of renewables and electric vehicles has also played a huge role in keeping demand stagnant. Meanwhile, in developing economies, the story is completely different. As these nations continue to expand, so does their need for energy. Typically, when a country's GDP grows, energy consumption rises along with it. But in developed economies, efficiency gains have kept that in check, something that has been happening since the early 2000s, with improvements in fuel efficiency and building design. More recently, renewables and EVs have added to that trend, cutting into oil demand even further. So what does this mean for the industry? In mature economies, there's simply less reason to build out new infrastructure, particularly when it comes to refining capacity. Instead, oil and gas companies are shifting their focus to optimizing existing assets and supply chains. In fact, one of the most interesting side effects of this transition is the boom in oil and gas data and analytics, which has now grown into a $15 billion a year market, expanding at 20% annually. But in the world's fastest growing economies, demand is rising faster than efficiency gains can offset it. For oil and gas companies, this means higher volumes in the medium term. It also means there's a pressing need for new infrastructure and refining capacity. And for many of these nations, which are net importers of oil, these imports don't just fuel economic growth, they also influence currency strength and borrowing costs. Now, shifting gears a bit, let's take a look at the US oil and gas industry, where things have been evolving rapidly. If you were to open the stock screener and rank US oil and gas companies by their total score, a few clear patterns would emerge. The companies leading the pack tend to be oil services firms, independent oil and gas producers, and large integrated energy giants. On the other end of the spectrum, infrastructure companies and LNG producers are struggling to keep up. These rankings reflect deeper industry dynamics at play. Upstream oil producers, those responsible for drilling and extracting oil, are highly exposed to price fluctuations. But at $70 to $80 a barrel, most existing assets remain profitable. New wells have become more expensive to drill in recent years, but that cost pressure has started to ease. And with Donald Trump's deregulation agenda potentially on the horizon, production costs could fall even further. Oil service companies, on the other hand, aren't directly affected by oil prices. Instead, their business depends on how much activity is happening in the industry. When drilling and exploration ramp up, they thrive. Meanwhile, storage, transportation, and refining are becoming increasingly challenging. To generate strong returns, companies in these areas either need rising volumes or razor-sharp efficiency to boost margins. Integrated oil and gas producers, however, are in a stronger position. Since they operate across the entire supply chain, from drilling to refining and distribution, they can improve efficiencies and reduce exposure to price swings. At the same time, the outlook for US natural gas has taken an unexpected turn. The US was set to replace Europe's gas imports from Russia, but if sanctions on Russia are lifted, then piped gas from Russia could become the more attractive option for European buyers. Since LNG is more expensive to process and transport, it would be difficult for Europe to justify using it if a cheaper pipeline alternative becomes available. On the flip side, demand for electricity is surging, partly due to AI data centers, which could provide a new source of demand for natural gas. But even that story is shifting, especially with new developments like DeepSeek's R1 model, which could alter energy consumption patterns. Regardless of what happens with Russia or AI-driven electricity demand, US domestic demand for natural gas is likely to keep growing, unless there's a major breakthrough in battery storage or a big wave of nuclear investment. Now, while the US is the largest oil producer in the world, a huge portion of the crude that gets refined there, about 40%, is actually imported. And most of that oil comes from one place, Canada. Canada has been and will continue to be a major player in the global oil and gas market. Last year, its exports got a big boost with the launch of the Trans Mountain Expansion pipeline, which tripled its ability to move oil and refined products to the Pacific coast. With this additional capacity, Canada is now in an even stronger position to supply China and other Asian markets. Speaking of Asia, let's talk about two of the biggest energy demand drivers in the world, China and India. For more than 2 decades, China has been the dominant force behind global oil demand growth. But now India has taken the lead as the largest source of new demand. While China still consumes more energy overall, it has been aggressively expanding its use of renewables, biofuels, and electric vehicles, which has helped slow its reliance on fossil fuels. That being said, both China and India remain heavily dependent on coal and oil imports. Because of that, refining and distribution are key industries in these economies. In many developing nations, governments also play a major role in the oil and gas industry, often owning large stakes in key companies and sometimes even regulating prices. While this kind of involvement has its pros and cons, it does provide financial backing when needed. Now, stepping back to look at the bigger picture. One thing remains true. Oil is still a cyclical commodity. We've seen just how wild these price swings can be. When the COVID-19 pandemic hit, oil prices collapsed to nearly zero. Just 2 years later, when Russia invaded Ukraine, they shot up to $130 per barrel. Because oil is expensive to store, even small imbalances in supply and demand can lead to extreme price moves. These fluctuations don't last forever, but they create massive investment opportunities for those with a long-term perspective. Right now, supply is growing while demand is sluggish, and that's already being reflected in oil prices. But surprises, whether on the downside or upside, are always on the table. And that's where we'll leave it for this week. If you enjoyed this episode, don't forget to like and subscribe, and please let us know if you have any feedback because we'd love to hear from you. I'll see you next week for another deep dive into the markets. Until then, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data.